All right, hi guys. We are officially live with our leaders in lending panel. I'm super excited and definitely feel very fortunate that the five of you have agreed to come on a panel together and really answer a lot of questions I think will be super helpful for our real estate community. I mean, the virus has completely created kind of a scare, right? The perfect storm for everyone. And there's been a lot of information going out, a lot of misinformation about what's happening with lending and what's happening from lender to lender. So I really want to kind of get down to it and see how we can help our realtors be a better resource for their clients, and then also the clients a better resource for if they're looking for any sort of help as far as the CARE Act goes. Okay. All right. I'll let you guys introduce yourself really quick. I don't know if we lost Jen or if we just lost her video, but we'll start with Greg. You want to introduce yourself really quick?
Yeah, hey guys, this is Greg Matthews. I'm a loan officer with Certified Mortgage Planners based out of Lake Mary. We service the Central Florida area here, and happy to be on. Thanks for having me, Amanda.
All right, Josh.
Hey, I'm Josh with Fairway Mortgage, and definitely grateful to be part of this panel. Thanks for having me.
Absolutely. And Zach?
Hey everybody, Zach Bleznick, VP of Business Development for Home First Lending. We are a Central Florida-based mortgage lender with offices in Lake Mary, downtown, and East Orlando. And thank you for having me on here today, Amanda. And we're amongst a great group of professionals. I'm really excited to hear what everybody has to say.
Definitely. And last
Amanda, thank you for having me. I'm Deanna LaRosa with Union Home Mortgage. I'm an area sales manager. Main office is for me is in Celebration. Happy to talk to all of you.
Yeah, absolutely. We're just going to dive right into this. And guys, if you have any comments or you want to ask any questions, just go ahead and make some comments now, and we'll get to those as we go along. So just starting out, just from last month's influx of refi applications, kind of overwhelming lenders, right? You were probably already pretty backlogged and needing to hire staff to really keep up with all of that. And now to the coronavirus effects on the process in general, possibly moving people remotely. What are you doing as an organization to really adapt and change and really educate everyone?
Good.
And I'll start with you, Grace. We got Jen back.
Hi guys, I don't know what happened.
Okay. But I'll start with you, Greg, on that question.
Yeah, so definitely, I think everyone across the board got influx, like you said, with a bunch of refinance applications a few weeks ago, and that created a capacity issue with a lot of lenders. We had so much business. It's just a basic economic principle of supply and demand. As demand increases, price increases as well. So in order to kind of combat that, some of the lenders started to jack up interest rates. So the narrative was that rates are super, super low, and a lot of us loan officers weren't necessarily seeing it on our rate sheet. So it's just about educating clients on what exactly is going on in the market. Obviously a very uncertain time right now, so there's a lot of factors at play. But there are some opportunities, even with I'm sure a lot of other loan officers on the call would agree that just because it's not the lowest 0% interest rate like the federal funds rate, there still is a lot of opportunity for people to save cash on a monthly basis, and also to maybe get some cash out for an uncertain time like this where people are worried about losing their jobs. So even with an increase in the interest rate market or volatility, as you would say, there's still a ton of opportunity. So it's just about educating people on what's the best for their personal finance. Cash on a monthly basis, and also to maybe get some cash out for an uncertain time like this where people are worried about.
So we have just working hard. Some people think that everyone's slowing down, but we're not. Obviously, for the influx of the refinances along with our purchases, we just have a lot of overtime happening. We put a lot of things into play just to turn them around, close on time regardless. And we have daily calls just to handle the truck and make sure that we're putting priorities on them. So we've been able to, obviously you can, when you have an influx of refinances along with purchase going, you're going to have, backlog. But we thank God we had just hired a bunch of more people in our office department, and we're doing a lot of overtime.
All right, Zach, I'll let you go with your Ryan Plaza commenting on there for you. Can you hear me, Zach?
Yeah. So right now, yeah. Can you hear me?
I can hear you better now. Yeah.
Hello.
It's a little bit of a delay.
Can you hear me?
Yeah, I can hear you now. It's just a little bit of a delay. Josh, you want to go?
Yeah, sure. So
I love technology, right?
only problem with a live demo. Yeah. So it's interesting because the industry was already kind of over capacity before coronavirus hit, and so we had, the mortgage industry as a whole does about 2 trillion-ish a year in volume, and there's about 11 trillion in mortgage debt in the country, and about 6 trillion of that was eligible for a refinance because rates have come down so low, right? This is all pre-coronavirus. And so, you layer coronavirus on top of that, and, people are trying to figure out, how do we work from home? How can we execute all this stuff in, rapidly changing environment, right? So one of the things that we did is we have strategically kind of just educated our clients that are wanting to refinance that, if we take 30, 45, 60 days to complete the refi, it's okay, because rates are going to be low for a very long time. And I think, I've heard different projections on this, but rates could even go lower than they are right now. So we've kind of chosen to prioritize the purchase business, just educating folks that, the refis are going to be there. That's just real. We're just, because we view ourselves as advisors more so. And so we're just shooting people straight that that's what we're doing. And, we're keeping people in, interesting times for sure. So
yes, definitely. Thank you.
Yeah, no problem.
From Movement Mortgage, what are you guys really doing to make sure it's still business as unusual as possible, right?
Right, definitely. New times, as you can see, technology challenges are always another thing to overcome these days. But we're doing a lot of the similar things that Josh mentioned. We are a purchase-focused company. Our realtor relationships are our most important asset, and the clients that we're working with that are purchasing homes that have closing dates and have moving dates scheduled. So we actually have created kind of 2 streams that people will go down. There's the purchase transaction that is still happening as it normally would. The movement mortgages process and going through the standard process that we put all of our clients through. And so we have our teams that are dedicated to that. And certainly there are constraints and there are limitations and hiccups that we face with getting verification of employment and just extra time that we take for some of these things. But really we're just focusing on communicating with our borrowers, making sure that process moving. And then the refinancing will never interfere with transactions. Volume on a whole separate channel and kind of a whole separate stream. And so those brought in some other people to come in and assist with them, train some of our processors and some of our assistants to help process refinancing so that it's not taking away from the purchase business that we have. But I think the biggest thing is just staying in communication with our clients when obstacles do come up, when things change throughout the process, so that we're sitting there to help. Sometimes we can get in touch with their employer better just by talking to them and saying, hey, can you get me a phone number for someone at your company that we can reach out to, even though nobody's at the office today? So that's really what we're doing to continue maintaining our expected turn times on most of our purchase transactions.
Perfect. Awesome. Welcome back, Zach. Mute you. Gotta love technology, right?
Yeah. Anytime I'm on these live streams, my Surface Pro wants to go crazy. So actually, I'm on my cell phone right now. So hopefully you can still see me all right and hear me.
Yeah, sounds
much
good.
better.
Yeah, much better. So
All right, cool.
I'm not sure if you remember the question, but just basically, what are you guys doing as an organization to really adapt to not only that influx of refis that were coming in, but now the influx of questions and uncertainty with the rates changing by the minute, right? And
Sure.
what did you do to really adapt?
Yeah, so we beefed up certain areas of our operations team as far as our disclosure desk to be able to handle the amount of refis that are coming in. We've created different buckets and put different processors on that so that they didn't have to skip a beat, or our purchase business didn't have to take a back door. The really cool thing is that over the last 15 years, Home First Lending has maintained its broker channel. So there's many different lenders. All of us here on the line, our business models are slightly different, but a couple years ago, we became a lender, a correspondent lender, and that allowed us to do different things, but we still kept our broker relationships live. So we actually have access to over 50 different investors. So right now we've been able to pivot pretty quickly and identify investors who still, can do different types of deals that maybe, some of these big box banks are no longer able to do, so that we can keep things going for our clients. Our loan originators on any given day can pull up this list and they can view turn times from different lenders. Some lenders are worsening their refi turn times, but keeping their purchase turn times intact. So it's just a matter of teaching them how to pivot quickly to say, okay, I'm a broker. Let me actually be a broker, because it's so funny. And I mean, Greg could probably attest to this. He probably used to send the majority of his business to maybe one or two lenders as a broker. But in these days, now we have to pivot and see what the best option is for a client, and just having access to that has been extremely helpful. And as far as, educating, we do a live series just like this one every week. We try to put out as much content as possible. We do a marketing meeting every, Tuesday morning. It's just about content, making sure you're getting really great, relevant information out there. Now, I'm not as good as Greg on Instagram and getting out there. This man, I'm a little jealous of, he's very wise for his age, but I think all of us, just making our own unique contribution together as a community really is supporting the realtors here in Central Florida. And it's exciting to see everybody kind of stepping up and doing that.
Right. Yeah, and I think you just said it perfect, right? It's so nice to see a group of lenders be able to come together and really talk about what are the best options for our community, what are the best options to serve our community, and of course the clients in their best interest in such a time of uncertainty. It's not usual, right? So, and every one of you brings such a unique thing to this. So I'm excited to keep going. So basically, your favorite question, I know, is always about rates. So we're going to dive right into that one. But rates are changing due to the volatile market right now. What do the conversations really look like with your buyers? As I'm sure every minute is now a good time to buy, and really, what does that look like? Are rates even a priority anymore? So we'll start with Greg on that one.
Awesome. Thanks, Amanda. Yeah, it's obviously a case-by-case basis right now. There is definitely a lot of uncertainty. Obviously, people that are in the hospitality industry, which is a big industry here in the Central Florida area, are getting furloughed. So at that point, there's not really much that we can do. They're not currently having income. So at that point, that's kind of a dead stop. But for some people that potentially, have very secure jobs or aren't as worried necessarily about that, they are selling their house is currently pending, or their lease is up, or what have you. There's a lot of people that still need somewhere to live. We all need shelter, right? So there's still a ton of activity going on. But it's what's so great about, all of the people on this call is that we're able to have those conversations with our clients directly and provide that value and really educate them on a case-by-case basis versus, maybe like Zach was saying, some of the big box lenders, they don't have that kind of ability to really go deep and do that kind of stuff. People are just churning and burning. But we really, I think I speak for everyone on the call, that we appreciate on the broker side, direct lender side, regardless of what it is. But in our model of business, so relationship-based, value-based, and really providing that education is going to pay dividends, across the board for us, for consumers, and for our real estate partners. Just being honest and coaching people on a case-by-case basis.
Yeah, I love that. Thanks, Greg. And how about from your end, Deanna?
Okay. Yeah. So obviously, a lot of people rate is important, especially for us when you're in the LaRosa Realty. You know, we're the affiliate lender, so there are some people that care more about the service and making sure that you can close the deal, and then there's rate always comes up. So I think for us, we're competitive rate, so it's not a major concern. But right now, I think people should be more concerned about getting the deal closed, right? So making sure that it's a strong bank, so that we're able, you have the strong financials so that you can stay in it. You're still going to get your warehouse lines. We service our own loans. So we've been able to really pivot really quickly in helping people without any kind of delays. So I think rate is an issue to some degree, but there's a lot of erroneous information out there. So I think we all got hit with that. Oh my God, rates are 0%. Like, what? So, that happens with people, again, baiting, trying to get people in. So I think and from what I know, the people on the call, it's just being authentic. And this is where we are at. And you should be concerned with closing your deal, and getting what you were told you're going to get, and just being transparent.
Yeah, like you said, relationships matter so much now, and making sure that everyone is staying well informed. Josh, from your perspective, what do those questions look like? What are your conversations with those buyers?
Yeah, so like everybody else on the call, we got a lot of that. Our rate's 0%. We heard rates are low. The federal government's trying to help, right, stabilize the housing market by keeping rates low, and so that is a good thing. Rates are fluctuating every day, so I think that's where we all come in as advisors and try to guide the client to understand, when is the right time to lock relative to what their situation is, whether it's a purchase, when their closing time is, or if it's a refi. And so, we're just guiding people. Rates are still near all-time historic lows, and that's a beautiful thing. I think something that is missed probably by many people is that this is an unusual time in the sense that, we're looking at rates, right? Every consumer, I'm a consumer, right? I care about the price, which is ultimately what the rate is. And so, but in these times, a question that not a lot of people are asking is, will the loan close? Is the lender prepared to weather this storm? That's something that, consumers haven't really had to think about. And so, that's, I think, something to, consider in, when you're picking a lender, or if it's a realtor picking a partner, what does their cash position look like? What kind of warehouse line setup do they have, and things like that. So just something to think about,
Well, if somebody had that type of question, Josh, is there like a general resource that they can go to find out that information, or is it just kind of a conversation?
Yeah, I don't know of one. I think anybody else on the call knows one. I think, some companies are public and some are private, some are sharing the information and some aren't. For example, one thing that happened is, when the non-QM, these are basically like bank statement programs and things like that, not Fannie Mae, not FHA, not VA product, and a lot of the jumbo products basically seized up. In other words, there was no market to sell these loans on the secondary market pretty much overnight. And so, if you were a lender and you had $100 million of these loans on your house line, and now you can't sell them, if your cash position was way less than $100 million, you got a big problem, right? So those are kind of things that is turning on a dime right now in this business, where if your company isn't properly capitalized, that, it doesn't matter if they're telling you the rate's 3% or whatever they're saying, the question is, can they close? Are they financially prepared to weather the storm that's ahead? And that's a question that, like I said, we just haven't had to think about that in at least 10 years, since the last big recession. And, it's a question to ask. I mean, I think realtors should be asking their lending partners that for sure. And consumers should be thinking about that and asking their lender those type of questions.
I love that. I love that you added that point. And we get that question from our end on the title side, and we're constantly provided information from our underwriters on what their financial position is right now and how far they can weather the storm as well. So that's such a great Yeah.
Thank you.
All right. Jen, we'll go with you. Oh, I think I muted you. Sorry.
Oh.
My apologies. There you go.
Hit the mute. My conversation with my clients and my agent partners about rates really is just honesty about where we are right now. We have seen record volatility over the last several weeks due to all of the concerns about the economy, unemployment, the government infusion in the economy. All of these things are causing rates to fluctuate more than we've ever seen before. And so what I'm talking to clients about and to my realtor partners about is that there is no rate is guaranteed. I'm definitely being a lot more clear when I'm sending out information or pre-qualifying someone at the beginning that this is where rates are today, but I can't guarantee that when you get under contract, this is where rates will be. Here's when we'll lock in your rate. Here's how we'll lock it in. And we'll go through that whole process, but there's no way I can promise that the rate I'm talking about today is going to be available tomorrow. And so talking and educating clients about it is really important. So that I can have those difficult conversations. If I do have to say, okay, I know we originally talked and rates was at 3.25, and now we're at 3.75, and this is where we are today. But that's just the reality of what's happening in the market. The other point to that, what I'm urging people to do is just communicate more with your lender, communicate even more throughout the process. When you're getting ready to go make an offer, it might be a good time to check our rates today. What will my payment look like? Am I still going to be comfortable there? Because we qualify people and say, here's the best guess of what your payment would be based on the price range that you're looking in. But rates can impact and can impact people's buying power as well. So if someone was pre-qualified with a 3.25 rate and rates go to 4, they may not qualify for the same price home anymore. So it's just really important to be in communication with your lender. Now is not the time. I would never discourage people from shopping, but now is the time to try to shop and find the very lowest interest rate, because by the time you get all the rate quotes back that you're looking for, the rate that you were offering yesterday may be gone. And so it's just important to act quickly and know when you're going in to make an offer where the rate is that day to take advantage of it.
Definitely. I love that. So just kind of going on to that as well, I know that puts an added strain on everyone, especially as loan officers, like working all hours of the night, right? You guys are definitely feeling that. So what sort of measures are you putting in place, like on the weekends, if a buyer reaches out and they're just like, what do we look like now if we make an offer and we lock a rate on Monday? Are you guys pretty much available 24/7 right now? Yeah. Sounds like you got a consensus on that.
I don't think that's much different in our line of work.
Yeah, it's probably no different, right?
We've got more people right now.
Yeah, when someone's looking to buy, get a loan, you have to be available.
Yeah.
Whatever time it is.
All right, Zach.
You had to put me last, right? Everybody took all the good answers.
Keep you on your toes. I'll mix it up. I'll go the other way next time.
Nah, it's all good. No, if you analyze data, historically, the big question is, you say here, should I buy right now, right? And people are nervous. It's a scary time. People are losing jobs. There's uncertainty. They're saying, man, if I lose my job, I need access to, my emergency fund. Should I use this to purchase a house? And, the reality is that still purchasing a home is one of the best and most stable investments you can, really ever have. And obviously you lose your job. There's nothing you can do about that. But if you look historically over time during recessionary periods, interest rates have actually remained low and been lower throughout. So it is a good opportunity to buy, because people say, well, let me see what home prices are going to do. Home prices might dip down during this time because of the coronavirus and everything that's happening right now. In any normal situation where rates could go up and down, if you wait and let's say rates do go up and you have a spike and prices do go slightly down, let's just play, devil's advocate with that standpoint, you're in the same position, right? Price goes down, rate goes up, you're the same place you were before. So I always like to tell people on our team that, listen, if you have a comfortable payment, it's good for you and you can get into a home now and be a homeowner, then do it, because it's much better than paying somebody else's rent during this time. Safe haven, your homestead, that home can't necessarily be taken away from you unless, of course, you default on your payments and that forecloses, but it protects you in other areas of your life. So it's always a good time to buy, right? There's up and downs in every single market. You just have to be comfortable to do it. Interest rates, like Josh said, are at all-time lows. So I remember when I bought my first house back in 2009, I was at a 7% interest only. So I'll take a 4%, any day of the week and be happy with that. I wouldn't be too alarmed. If you're in the market, go ahead and pull the trigger.
Yeah, definitely. So that's all relative, right? I love that Josh sent a private message. He was just putting it in. Yes, I think the Fed understands what they did with buying too much mortgage-backed securities, and I think it's unlikely that we see another 2% swing in rates in a few days like we did a couple weeks ago. So throwing that 2 cents out there, just to give a little bit of sense of ease and peace, right, with the volatility. Perfect. All right, so we'll the next question. So I really wanted to, Deanna, this is really for you, just UHM being such a large company, and they're very big on publishing things on MoneyWise and Money.com and on Forbes about their financial position and what their overlays are, and just making sure that they're constantly communicating daily with the community. Tell us a little bit about the communication just being a number one priority from your standpoint.
Our huddles every morning with the whole entire sales team, and then obviously operations has theirs, and then every day it's just constant communication. And then we have what we call our rock call, and then it's from the leadership with Bill Cosgrove, Jim Ferreter, just speaking into all of us, everything that's going on. Obviously, Bill Cosgrove is very involved. He was in charge of MBA at one point, and he's in charge of he's very involved in legislation. So he shares all that with us, which is great. And then with our LaRosa Realty relationship, we're obviously pushing out information. So we did like a Q&A with some guideline changes. Now, it's a little bit harder to get VOEs, right? People working from home, different things that will change with that related to bank statements. So we've kind of just want to make sure everyone's aware of it ahead of time. And it's been well received that we're communicating on a regular basis. So communication is always the key, and that's what we're trying to do from the top level down.
I love that. So really, this is going to be kind of a question for everyone. So the CARES Act, we're getting a ton of questions on this. I know Greg's been really instrumental in publishing a lot about it on Instagram. If you guys don't follow him, definitely do it. He's a great resource for that. But homeowners can request a forbearance or deferred payments. Can you kind of help us understand what the difference is and how those products might affect the help that they can get? I know that there's a lot of things going around about forbearance and what it actually is, and people not understanding it. So I'd love to dive deeper in that. And Zach, I'll let you shoot this one first.
Oh man, thank you. So, in reality, it just comes down to forbearance does not mean forgiveness. And a lot of people are thinking that, hey, if I just, stop making the payments, it's being added to the back end. And the reality is that a lot of people are, maybe calling their car companies, credit cards, utility bills, things like that. And yes, they're either skipping a payment or moving it onto the back end, but mortgages work very differently, and it's going to be very servicer specific. So will there be some banks, some servicers that will just add it onto the back end of the loan for you? Sure. But the majority of them out there is a forbearance is just a temporary stay in being able to make the payments. So at the end of that forbearance period, if it's 90 days, 180 days, however long it is that you're doing a forbearance period, that money is becoming due and payable in full. So if you didn't have that money to pay it, you were out of work, then how are you expected to get caught up? And the challenge with these forbearances, and I could actually publish a video after this as well, is that it's a no questions asked type of policy. And that's where a major problem occurred, where for instance, back in the day, you wanted to get a loan modification, right? You had to fill out some type of questionnaire. Now it's a no questions asked. Yeah, we'll put you into a forbearance. If they had just put a small little questionnaire in the beginning where you had to share some information, they would have prevented a lot of people from applying for the forbearance that didn't really need to, right? And make sure that people who actually need it. So this is affecting a lot of things. Like, for instance, I've seen some investors email us saying, if you're in the process of doing a forbearance, we can't close on your loan anymore. So we actually are sending out a DocuSign to all our current refinance clients, letting them know, hey, if you're going to be doing a forbearance, you have to notify us because there's a chance that the lender will not move forward. Same thing with purchases. Some people are not thinking about it, is that the lender, if they identify that you're, let's say you're buying an investment property or a second home and you stop making the mortgage payment on your first, that lender might not want to lend to you anymore. So it's really important that you don't exhaust that option unless you really have to. And this is what's happening, why all of the programs are starting to tighten up, why there's lenders increasing FHA credit scores to 680 as an example, because they're hedging their bets and knowing that the likelihood of a default rate of people with lower credit scores is much higher. And if those people lose their jobs, they're stuck with the servicing costs. Now, the government is intervening and saying, if it gets too out of control, we're going to help you out with that. But how much government intervention can we get? So, yeah, I mean, I'm sure there's some to add on that, but that's basically in a nutshell.
No, that's great information. Thank you, Zach. So it's super important with the forbearance questions and all of that. If you are going to be buying a house, what you're saying, or refinancing, that you're asking your current lender, like, what does that look like and how is that going to affect my ability to do that in the future?
Right.
So that's super important. Jen, I'll go with you next.
I think Zach covered it pretty well on what the forbearances are and some of the ramifications. And I think we don't know, even further down the road, he alluded to, possibly if you're in a refinance right now or looking to purchase something right now, but we don't know if 6 months or a year from now, people will have a more difficult time getting a new mortgage if they want to buy a home or want to refinance down the road based on having taken advantage of the forbearance. So for me, the most important things to do are only take advantage of absolutely necessary. Zach mentioned that there is no application, there's no hardship proof that you have to provide. So even people who say, well, you know what, I mean, I'm working, I don't know what it's going to look like in a couple of months, so I'd rather go ahead and take the forbearance. Please don't do that. Go ahead and continue to make your mortgage payments if you can. And then the other point, just to continue to drive home, is call your servicer, get the very specific information about your loan from them. Don't assume that they're going to add it onto the end. Don't just stop making your mortgage payments. I've even had clients who've gone online and applied for a forbearance and got an email saying, hey, you've been approved for a forbearance. Great news. And so they're like, does that mean I can stop paying my mortgage payments? But they don't actually know what the repayment terms will be of that. So get specific, find out exactly what your servicer is offering, because if you don't, you could be in big trouble come 3-6 months from now when you have to repay all those missed payments at one time.
Perfect. Thank you for that, Jen. So Josh, I'll let you kind of delve into that as well. I know we had a great conversation just kind of specifically going into that about forbearance and what that true cost looks like. And you really educated myself that I didn't understand it either. So when really somebody weighs out the true cost of forbearance and putting those payments off, what does that look like for a homeowner?
Yeah, it's a great question. So great answers by the other panelists so far. Something that, was shared with me recently was an undiscussed cost of this. If people, let's say, there was an example that with a $250,000 mortgage, if somebody is able to delay the payments for a year, for 12 months, and making the extraordinary assumption that the lender is going to allow them to just add that to the back of the loan, they're going to owe about $6,300 more if they keep the house 10 years, which is the average that people are keeping homes right now. They're going to owe about $6,300 more on the loan than they otherwise would. Additionally, they're going to have that's just the regular amortization that didn't take place because they didn't make those payments the first year. And then they're going to have, a lot of us might remember from the Great Recession where people got modifications and there was like an additional amount of money added onto the loan that was non-interest bearing. And so that money doesn't go away. That money just kind of goes on as a non-interest bearing portion of the loan. And then when they refi or sell, then they're still going to owe that money. So, there's costs. And, the others mentioned, qualifying, we don't know. I think a lot of servicers don't know. They're kind of getting their policy together. Are we going to let people add it to the back? Are our investors going to allow it? Because what these things really are, mortgages are sold as an asset. It's a debt product sold as an asset, like on Wall Street. So the asset is because it's a payment stream. You're making a mortgage payment every month, right? So if you sell an asset, which is an income stream, and then the income stream stops, what is that asset worth? And so this is the problem that, people are trying to figure out. Servicers are trying to figure out. The federal government's trying to figure it out. But the reality is the policymakers, even on Capitol Hill, which kind of surprised me, they wanted to help. So they started saying, hey, let's help people. But like Zach and Jen said, there's no test for, suitability. Like, do they need the help? Are these people still working? And so I think everybody else on this call would agree. I think there's no clear guidance out right now of how lenders are going to treat this in the future. Is it going to be considered a good payment history? There's no negative credit reporting allowed, but mortgage lenders might require a verification of mortgage to be manually completed. And then if they can't complete it, so there could be other consequences down the road that, we're encouraging people, if you can make the payment, it's better for your life to make the payment. You're eliminating uncertainty out of your life that you don't need to add in there. If people are having a hard time and they're laid off, by all means, take advantage of it, because otherwise you would be hurting your credit. But man, if they can make the payment, it's going to be a lot better for them if they can do it.
That's such a great point. So I think just making sure that they understand that these lenders and underwriting guidelines can change by the minute, right? So we don't know what's going to happen tomorrow if they do go into forbearance and how that might affect their family in the near future. So that's a super, super important point. Deanna, I'll let you kind of share from your perspective as well. And the biggest thing too is like, what are you really telling your realtors? You guys have such a large company of realtors and in constant communication, I know, in your online portal. So you're communicating a lot with them on like, what are you telling them to say or not to say to help out their homeowners?
Well, we're trying to get them to say nothing and send them to us. I mean, just to add, because everybody really touched on everything. So, I mean, just from my perspective, I just would say, don't take advantage of something that you don't know how it's going to adversely affect you down the road, because there's still so much unknown, right? We don't know. We know that they can ask for a 6-month forbearance and then another 6 months onto that. And we know the service that they're going to be required to make those payments for them. But we don't know when it's going to be due and how it's going to be handled. Is it going to affect their credit for purchases down the road? We don't know any of that just yet. So again, if you don't need it, and a lot of times, on some purchases, people have to, don't just jump into something if you don't need to. So we're kind of just trying to educate them and speak with them and just hold their hand through it, whether they need to really do that or not. I mean, obviously, if they need to do it, they need to do it. But we're also hoping with the SBA and the small business help that's out there, that if they were laid off or let go or furloughed, they'll be taken back, because these now small businesses have the ability to hire back their employees and therefore get a business loan. So hopefully if they wait it out and that happens, they'll be back to work and we won't have a really bad issue.
Yeah, that's great. Good information. Greg, from your perspective, what are you really seeing, and what are you, if somebody calls you, how are you educating them on what to say or what to do?
Yeah. So just to kind of piggyback, I had like a million thoughts going through my head as everyone was speaking because I love this stuff. It really intrigues me, everything that's going on with monetary policy on the Federal Reserve and fiscal policy of Congress. And I think kind of to piggyback a little bit off of what Josh said, Congress has done a ton of different things to try to, keep afloat and stabilize the overall economy. And obviously, a majority of American wealth is in their homes, and so that's a big, big part is making sure that people don't lose value in their homes and people are able to pay their mortgages. So that was just kind of an emergency thing that they did. They threw out this policy. They did it really, really fast to just try to help people because that April 1st deadline was coming with mortgage payments. So much uncertainty, like everyone was saying. Like some people are hearing 3 months of forbearance, then on the fourth month, the full amount is due. Some people are being told that it can be deferred to the end of the loan. Some loans are going to have interest accrue, some are not. There's just so much uncertainty on that aspect that it is a servicer specific kind of ask. And so if a client's calling me and saying, hey, should I go into loan forbearance? My first, initial discussion is, can you afford to make your mortgage payment? What other bills are you paying first that you're putting as a top priority over your mortgage? Because your mortgage is truly your first and most important bill that you should pay. It's where all of us together as Americans have a majority of our wealth. It's the asset, like Zach was saying, it's one of the most secured and valuable assets over the life of owning real estate. But it is something that we saw in 2008. If there's high defaults, if there's a lot of foreclosures, it does take a pounding and people really lose a ton of wealth and it takes a long time to recover. So the housing market is very important to keep afloat. I think that starting with consumers and forbearance was a good start, but only if you truly need the help. Like kind of Deanna was saying, if you're thinking this is a free lunch, there's no such thing as a free lunch. It's not a free pass. You will pay in some form or fashion that money back, maybe even more, as Josh was saying, in addition, on interest or extending the term or what have you. So people need to be really, really considerate. A lot of people just think, oh, I can, skip my mortgage and think about it later, but that always ends up, coming back down the line. So we'll see what happens. The servicers are the ones that are having all the stress right now. How are they going to pay the investors? So as a consumer paying your mortgage, you're providing a lot of relief and a lot of job stability for your fellow citizens that are working for servicing companies that hold mortgage-backed securities. And if you're looking to refi, you're paying your mortgage now, you're ensuring that you have a better opportunity to do that down the line because we don't know what's going to happen next. But I think Congress is going to step in with an additional stimulus and kind of help provide relief as everything's shut down. But if you can pay your mortgage, you should definitely do so.
Great. It sounds like you guys are all unanimous on that. So I appreciate all that feedback for sure. So kind of one thing that we've been hearing a lot, and I know it's been a lot of misinformation out there on a lot of forums, specifically in regard to the squeezing of guidelines and overlays that are being added by lenders and investors. So I know it's very lender specific, but just for each one of you, so we can educate the realtors that are listening or anyone watching the video from a consumer standpoint, what are some things that you all have put in place as an organization when we say overlays, and specifically overlays being something that you put over top of certain requirements, right? So to protect yourself as a lender. So if you can kind of touch on that, I'll start with you, Greg, and we'll go that way.
So, I mean, there are definitely ever-changing overlays in an uncertain market like we're seeing right now. Obviously, like we were talking about a little bit earlier, non-QM, so your bank statement programs, some of your stated income programs, your no owner, no occupant, investment programs, those are all starting to be suspended as far as funding because there's no market to sell these on the secondary market. People would be taking a loss in order to sell these on the secondary market. So that, economically, there's no real need for them to want to fund those loans. So everything's tightening up. FHA, a lot of people are increasing their minimum required credit score, other things like that to combat with credit risk. But it's just about constantly staying in front of it and educating your pre-approved buyers and your real estate partners that are actually interacting with these buyers about, the ever-changing marketplace. Because It is something that if you might have had someone that was in that kind of, lower tier credit score range, and then all of a sudden that they're pre-approved out shopping, all of a sudden that overlay comes in and that changes things. So it's just about educating people on what's going on in the market, and it's ever changing. And I don't think we've seen the end of it yet. I think it's going to continue to change. And we'll just have to stay on top of that and make sure that we're providing that value and education to everybody.
Perfect. Thank you, Greg. Deanna, I'll let you kind of touch on yours as well.
I think some of it's just been that common sense, with the lower credit scores, and definitely the same thing with the jumbo non-QM. That's kind of like a halt right now. And a lot of like down payment, like the Florida bond type programs, those are kind of like a halt right now. And then it's just common sense taking a look at the file, which we've kind of done all along. But yeah, our minimum credit score did go up, but not 640.
640, perfect.
680. I don't know how anyone's closing loans if they're starting at 680.
Am I up?
Yeah.
No, I agree. I agree with Deanna. I think 680 is tough. There definitely are some lenders there. I think it's interesting because what happened is lenders started to have to think differently than we have before. Before we're looking at, does this loan meet, Fannie Mae guidelines, FHA guidelines, this particular investor's guidelines. Now we're having to think about, are these folks going to pay? Are they going to have a job to make their first payment with? Do they have any reserves? These are different questions as an industry that we have never had to think about, even in the last recession, not at the level that we're looking at it right now. So every lender, going back to the capacity issue pre-coronavirus, right? Now, a lot of folks are having additional capacity issues. And so if you're a lender and you have X amount of money to lend with, obviously you're going to want to try to lend that money to folks that are likely to pay. Because, if folks can't pay and then lenders are making loans, then big lenders are going to start to disappear from the marketplace at a high pace. And so everybody's trying to work together so we can all be around to help the real estate community, to help clients to be able to get mortgages on homes or to be able to lower their rate with a refi. I think it's interesting because the government loans work a little differently in servicing. So that's another interesting point for people to understand, is that, the servicer has to still make those payments to the investor on government loans. And so if somebody quits paying their FHA mortgage, that servicer still has to make those payments. So that's why those loans got hit a little bit more than others. And it's an evolving situation for us. We're looking at it. Our executive team is looking at that on a weekly basis of what we want to have as our minimum score. Right this minute, it's also 640. I think a lot of lenders are there. And another thing that a lot of folks have done is lower the debt to income ratio maximum, which in layman's terms, it just reduces a little bit somebody's buying power, is one way to look at it. I think, but also it's prudent. I think, if you have a debt to income ratio of over 50%, what does that mean? That means that your mortgage payment and your other payments are half of your before tax income. So if you think about that, that's tough. That's a tough way to go through life. It's hard to win financially if before you pay taxes, buy gas or groceries or anything, half your money is gone. So I think this is a good time for us as professional advisors to talk to clients and educate them. What does it mean? How can we help you get your credit score up? How can we help you rearrange your debt situation, which a lot of refi conversations are going there, to help somebody to have a debt ratio under 45, even if the loan doesn't require it, just because it's helping somebody win with their money, So, but I think everyone will echo this. I think it's a daily, sometimes, but for sure weekly, lately evolving situation for us in terms of what these overlays are. So,
for sure. Kind of going back to your question earlier, where you were telling the consumer to really ask their lenders, what their solvency looks like through this process. Would the addition of overlays give you an idea of what that looks like in the future?
Yeah, that's a great question because, I think so a kind of a little bit of a loaded question, but I'll try to answer it. So I think, in my opinion, this is just one man's opinion. Okay. I think, the prudent thing to do at that time was to look at your minimum credit score requirements and your debt to income ratio maximums and say, what's the wise thing to do right now so that we can stay here for the community and for our realtor community. And so we've seen some folks out there saying, hey, we're still doing credit scores down to 580 or below. And there are some people out there doing that. But one thing that I think nobody's really talking about is those lenders that are out there saying this, are they going to be around to close that loan? I mean, I think some of us were around in the Great Recession. I think probably everybody on this call was around for that and remembers having clients sitting at a closing table and they get a call that, hey, there's no money, the lender's shutting down. And so this is a very real thing that could happen if there's lenders out there saying, hey, we'll do the 580s. That's not a knock on anybody. That's not, anything negative, but it's just something for people to understand. If I was buying a home right now, I would be thinking really hard about getting my credit score over 640 so that I have lots of options and that I don't get stuck with having to go to one place that may or may not be there in 30 or 60 days to help me to get that house. I think that's the message that we should be helping people understand in this time, because I think, it's like what everybody said, it's an evolving situation. And so I think, I know I feel better when I have more options. And right now, credit score over 640 gets you a lot more options.
I love that. That's great advice. Thanks, Josh.
Sure.
I'm kind of going into Movement's perspective on this one. I know Movement has always generally been such a great company for that very A-rated buyer, right? The one that can get closed very quickly, doing really well with those conventional products. So how is it changing with overlays for you all, and what are you seeing on your end?
So we're going to take all those 580. I'm just kidding, actually. We've also tightened up our restrictions. 580 used to be our minimum credit score, and not the majority of our business, but we did help service. And we always try to look at it from a perspective of loving and valuing our clients and wanting to make sure that we put them into a product and into a home that they can afford and that they're not going to have to be making the mortgage payments like Josh said. And so we also want to be around and want to make sure that we are doing what's best to keep our company strong so that we can continue to lend and to be supportive in our communities. So we also have restricted our credit scores to a minimum of 640. We have some debt to income ratio restrictions between a 640 and 680. We're limited to 45%. And then above a 680, we can go up to 50% on our government loans. So that would encompass our USDA, VA, and FHA programs. We have not really seen any restrictions in the conventional side. I'm sure everybody probably will agree there that we are still able to do what we were doing before on conventional guidelines, although I do see there may be some room for some tightening up of those coming down the road. We may see Fannie and Freddie tighten up their guidelines and their underwriting platforms a little bit. But the majority of our buyers are still eligible, and we also are always willing to help to get them where they need to be. Certainly the options open up and the rates are better when you have a 680 credit score or better, or 640 or better. And so we're going to coach our clients to get them where they need to be if they're not there yet.
Thank you. It sounds like that golden number is that 640, right? Zach, I'll let you touch on this as well. I know something that I have talked about in the past is, if we really want to get the buyers to that 640 so they have more options and they feel more comfortable. I know there's like rapid rescore options and things like that. So tell us about your overlays and how you're really helping maybe some of the credit score people get to those options where they can see more potential.
Sure. And I just want to echo a few things that were also said, and most top lenders these days, when you do pull credit, a lot of us have access. Like, for instance, at Home First, when we pull credit on the first page of the credit report, it will tell us the potential score increase. So within literally seconds, we can determine whether a borrower has the ability to go over a 640 if necessary. And, you know, they don't have to go through a credit repair company and pay extra fees to do that, or have a 6-month waiting period. We could send them a report. They could do a rapid rescore. The challenge with rapid rescores now is that the bureaus are backed up. So TransUnion just reported that they're at 21 days to process any repository updates. So you're talking about possibly waiting 3 weeks, and that's putting people in different positions. I had somebody who was betting on getting at a 680 to have a better rate on a refi. They landed at a 679. There was something that we could do for them, but they're not going to take 3 weeks, because we're all dealing with the issue of protecting our locks right now. As the market is worsening and lenders are not wanting to hedge out longer, you know, to relock a rate or extend a rate, it's a cost. And, you know, depending on the situation, that cost could be potentially passed on to the borrower. And that's something we want to avoid when they weren't expecting to extend the rate. So it's just a matter of setting proper expectations. The one thing that I also do want to comment on, in order for this conversation that we're having today to be successful in our local community, is that everybody in our real estate community, real estate agents, other vendors, need to echo similar messages. And, you know, the scary thing is, and this is just me being very transparent and real for a second, is that we're in a commission-based business. So yes, the individuals that are here on this call right now might be very fortunate. They're still closing business. They're able to make a paycheck, you know, in today's, you know, environment, even with the restrictions. But, you know, there are other people who, you know, might not have closed a deal in a while for whatever reason, and, you know, they're going to still be out there echoing that they can do a 580. So it's, you know, it's hard, because you never want to tell somebody no when you know it's possible, especially, you know, realtors like, well, can we get it done? Right? You know, can we do it? And the question you have to ask yourself is it worth the experience of trying to go to one of these 580 lenders who is still hanging on by a thread? Sure, we offer it. We've got a few investors still going down to 580, but is that experience for the buyer going to be one that's going to protect our reputation in the long run? Because maybe that buyer's taking 40, or that lender's taking 45 days to approve a loan. Maybe they're taking weeks to clear conditions. Maybe they have other restrictions that you don't know about, or you haven't worked with them a ton of times, so you don't know what's gonna, you know, you can't predict the experience. Now you're affecting so many parties, because when you ask for a 45-day contract and one of these lenders can't perform, now that selling agent, the listing agent, has to go back to their seller, say you're not closing on time, and risk their reputation. So there's a huge domino effect. We have to ask ourselves, is it worth doing these harder deals just for a paycheck right now, or do we want to protect our reputation and work maybe 30 days, 60 days to get somebody up to a higher credit score? As Josh said, have more options, have a cleaner and smoother transaction for everybody. You know, it's kind of on a case per case basis. And at the end of the day, I basically lead with saying, hey, if you're going to do it, make sure you set the proper expectations. And, you know, a lot of people suffer from what I call Superman syndrome. And they're like, I know this deal can get done, so I'm going to push it and do whatever I can. But there's certain things that we just can't control. So it's better to set the expectations up front. I've even said it over my career to clients who have 580, like, hey, you might hate me by the end of this thing, but I'm going to get you into a home. So it's just a matter of letting them know what it's going to take and for how long. And if the buyer, seller, listing agent, everybody's on the same page and they want to make it happen for that homeowner, then you could venture down that road. But again, with guidelines changing frequently every day, what's happening is what's here today might be gone tomorrow. So you have to proceed with extreme caution.
I love that. You know, just going into that too, I remember the days, Josh, that we were just talking about. I worked in title back in, you know, the days where they were pulling loans at the closing table. And, you know, it was very, very difficult time. So hopefully we can see that happen. But again, being very resourceful for your clients is super important. It sounds like that 640 is a golden score. Like Maria just commented on here, people who own the 580 should still be able to own. Ownership empowers people to improve their financial health. So it is a case-by-case basis. It just really depends on where they are in their life and where they're going, for sure. So I love that. And so just basically kind of going into that, also there's been many other and this is kind of be our last question. You guys have been so great. We've been going on forever. But just kind of going into that one, many are like fearful looking at that we're going to replay a 2009, right? And how do you think this will really shape mortgages in the future, if at all? And do you feel like the proper measures are being taken to prevent it, by Fannie Mae and all of the different entities that are part of this? So Zach, I'll let you start with that one.
Yeah, I'll keep it short for time. In 2008, 2009, this was spread out over a much longer period of time. We were taking 12, 24 months for lenders to adapt, change in these guidelines. You're seeing everybody react very quickly within a very short period of time. So I think that was a good play by our industry of, going along the lines of extreme caution a lot sooner and not, basically, preparing for the worst and hoping for the best rather than the opposite. So that's been refreshing. Obviously, we had the housing bubble as a component of 2008, 2009, and inflated prices, adjustable rate mortgages, stated loans. So people were in so many positions where they couldn't afford their mortgage. Stated loans were going away, so they couldn't afford it in the literal sense because the interest rates were adjusting, but they also couldn't afford it in the literal sense that they couldn't show that they can qualify anymore. So our industry has done a really good job in getting rid of all those kind of bad products and tightening up quickly. I think we're going to be fine. Prices haven't, plummeted overnight. There's still a lot of people buying houses and want to get in the market. But with things changing every day, I think there's a lot of things that we just haven't seen or don't know behind the scenes and how cash rich or cash poor these lenders are, as Josh alluded to earlier. So there's definitely going to be the strong who survive, who made decisions quickly to, tighten their guidelines, not allow rate locks until maybe the loan is approved or so they could hedge for a shorter period of time. And overall, I think that we're not going to repeat it. I think our economy might have some repetitive things that happened because of the unemployment rates, but for mortgages, I mean, time will tell. We're in a very unique position right now where people are where these servicers are going to the government and begging for money right now because they're receiving a lot more requests for forbearance that they ever imagined. And I think day by day, week by week, we're going to see how our industry is shaped as a result of this, but time will only tell.
Thanks for that, Zach. Jen, what are your opinions on it, and what are you doing to really kind of keep a peace of mind for people that might think we're seeing another market crash?
Sorry. Just to kind of back on that this is not 2008. 2008 was really caused by the mortgage industry and by the reckless decisions of many. And so we are in a position where home prices are not overvalued. We have done a good job to make property valuing the homes that people are purchasing. On average, I saw a statistic this month that said that overall in America, equity in homes is about 50%. I mean, that's pretty significant and far different from where we were back in 2008. We went into this with a strong economy, and typically when something like this happens, the trend continues. And so there was projected a 3 million unit housing shortage for 2020, and that still exists. There are still people who need to move. There are still people who want to buy homes. We still have a lot of demand in the housing market, and there's still a shortage of inventory. So I expect that after we're able to get back to work, and many of the people who have been laid off or furloughed are able to get back to work, we will see the housing market pick back up. And, there will be some economic ramifications from it that we don't yet know fully what they will be, and some impacts to our economy. But overall, we have a workforce that is ready to get back to work as soon as their employers are allowed to go back. So, it's a little bit different. And I think we'll see those unemployment numbers drop pretty significantly once the fears from the virus subside and we can get out in the public again. So I think we're in a very different place than we were back in 2008. I don't want to go back there. I've been through it once.
Yes, I hear you. Josh, what is your take on it?
Yeah, so a lot of people asking this question. I think it's interesting because in 2007, 8, nobody was saying, "Oh, it's going to be awful. It's going to be terrible. Homes are going to go down by 50%." That was the outcome, as we all know. Now, everyone, I feel like, is saying that, and everyone, I mean non-mortgage professional people, lots of chatter I hear out there is, "Oh, it's going to be just like before. Values are going to plummet." And I think the data just doesn't show that that's likely. So first, everyone needs to just be patient, realize this is virus-driven, not market-driven. The virus, we already have, treatments that are working. I think, the world is at work on a vaccination. So I think, this is a very short-term thing, probably maybe has a 60-day window on it. And what I've seen in data is the market going from an extreme seller's market to maybe more of a balanced market, not even really a buyer's market. I'm still hearing from realtor partners that there's multiple offers on still even right now today. And so, we have demographics shifting with millennials still buying first homes and even a lot of second homes. That's a huge demographic group that's coming in. Housing affordability is significantly better than it was in 2008. So I think all the data shows that, by the end of this year, we're going to have probably 2 to 3% growth in home values, whereas we had about a 5% projection before the coronavirus. So we're not even expecting to see no growth, a negative growth here with this awful thing happening that nobody saw coming. So I think it's important to get a little about it, look at the data, talk to a professional that's seeing this stuff every day. I've seen some of you on other calls. We're all educating ourselves every day on this about what's happening. So it's just important to look at what's really going on and not to just get your advice from a source that should be giving the advice.
Josh, if you were to recommend like one sort of resource for consumers to go to, or any realtors, I know you would probably say yourself in your videos, right?
Yeah.
But
Well, I mean, everybody.
Totally kidding. If they could read at night or look at something, what would be your advice?
So actually, great question. I would actually say try to Google this, because it's very complicated what's at play here. And really, the only thing that came to my mind is a third-party source that this has actually been very influential on Capitol Hill, fixing the policy that the Fed initially did with the mortgage-backed securities. A guy named Barry Habib, he has a company called MBS Highway. I would recommend any lenders to subscribe to this service. Barry, you can pay me later. It's a great service, and lots of good information there. I personally don't know of anything for consumers that I could say, hey, go to this website. A lot of us are posting stuff on our social media. I think the best advice there is really the major news networks, the local news channels, for the most part, unless they're interviewing an industry expert, is probably not the place to get your advice for this type of thing. You really need to go see somebody that's reading and learning about this stuff on a daily basis, like those of us on this call, so that we can help guide people through it. Because something great about technology and Google and Siri and Alexa is you can ask it anything, but it's very limited on what answers you can get, because the information is there, but understanding what it means and what you need to do about it is something that there's really, I think, no replacement for, which is great job security for all of us, right? I think there's just no replacement for contacting a professional that can help you understand what it means and what you should do.
Yeah, that's great advice. Thank you for that. Deanna?
I think everybody already touched on everything. To recap, this is definitely not 2009, 2010. And like everyone said, it was coming. It lasted over a long period of time. This is not like market driven, this crisis. It's event driven, right? COVID-19. So it's different. I think there's a lot more, the guidelines for lending makes it a much more responsible lending environment. And I think everyone involved is doing everything they need to do to keep it strong and flatten the curve, so to speak, so we can get back. So I do think, for sellers, it will soften. not maybe 100% a buyer's market, but definitely I think it's going to soften on that end. It's always a good time to buy a home. I mean, everything they're doing with the rates, even the guideline changes are really common sense guideline changes. It's nothing really bad that should kick a lot of people out of the market. So it's definitely not, this is not anything in comparison to 2009, 2010. I think coming out of this, we're going to be stronger. And the strong will survive on the real estate side, and the lending side, all the companies, everything we're all doing on this call to take care of our clients and communicate with them. I think we'll be stronger after this.
Definitely. Thank you. Any words of advice for resources to follow for consumers or realtors that you can think of?
So we are doing on Wednesday at 2:00. Joe and I are interviewing Bill Cosgrove and CEO of Union Home Mortgage, because he's so involved at a high level. So we're going to be asking him, questions related to the industry, the market, and everything he's seeing. So we're pushing information out from him and just from our companies.
Okay, great.
I know Barry Habib gives good information. I used to be part of MBS Highway. I've met him a couple times, but yeah, we're gathering and just pushing it out to all our clients and our agents, and we'll continue to.
Awesome. Greg? I think I got you unmuted.
Okay. You hear me? Okay.
Yeah.
No, I'll definitely second what Deanna and Josh said. Barry Habib is the best in the industry. MBS Highway, they do a fantastic job. He's been on a few different lives and stuff. And Anthony Casa is another name, the president of AIM. And they just do a fantastic job of kind of giving that macro perspective. I will say 2009, 2010, I was in high school, so I talk more in theory about what the experience was like. I do remember a bunch of houses. What's that?
Good way to rub it in, yeah.
I know. Sorry, I'm dating you guys a little bit now. So as far as what I can see, what I remember, obviously there was a bunch of really, really bad loans. There was a lot of subprime. Mortgage market was really big, and people were being compensated like crazy for putting people in those kind of adjustable rates and stuff. So people that might not have even should have been in those products were getting put in those products and not really prepared for what was about to happen. So overall, with reforms, the mortgage industry appears to be on the surface a lot safer, a lot more risk adverse. So that's a good aspect on it. But I will say, kind of to take devil's advocate side of this on the more maybe doomsday kind of prediction, and say that there is a chance that this could drag out a lot longer. Obviously, it's going to come down to the uncertainty of the coronavirus. How long does this last? Are we all locked in for 60 days, 90 days? Does employment hit 20-30% like some economists are predicting? And that just naturally would bring the mortgage industry to a little bit more of a freezing point, create a kind of a liquidity crisis, and in fact have houses decrease in value. It just would be a natural occurrence. Now, the great news is that unlike 2009, 2010, the mortgage and housing industry would not be the leading cause. As everyone else has kind of said, it is the coronavirus. So as all industry comes down together, as long as the federal government maintains that final backstop, which they said that they have, and they're going to be willing to do, and they can keep everything afloat, we'll obviously get back to normal at some point in the future. It just depends. Is this going to be a 1 month thing, 3 month thing, rest of 2020, or 2 to 3 years, which is definitely not off the table by any means as far as an overall economic recession. So that would definitely play a factor in the mortgage and housing market. So it's just a lot of uncertainty to be seen. We got to see how this plays out. But as far as the stability of the industry, our specific industry, it appears to be a lot stronger than it was then, where it was the leading cause at that time.
Yeah, thank you so much, Brad. I'm going to let Deanna and Josh kind of touch on, they were just doing a little private chat on the side, just really about so many people in the market and saying to sell and liquidate. Deanna, like, what is your advice to that?
So I've seen a couple of webinars or lives go out of people just saying sell everything, get liquid, like almost like to exaggerate a little bit, hide in the mountains. And so that kind of fear-based thing is, and if somebody is pushing you to do that, it's usually because they're going to benefit in some form or fashion, right? So what Joe and I have been just trying to say is don't act on fear and do things like people are pulling out of the market because they're when it comes to stocks and whatnot, because they're losing some, but it's always the long haul, right? Real estate has always been the number one way to gain wealth. Right. So, and regardless of the market, whether it's a buyer's market or a seller's market, you can pivot, whether you're renting or you're selling. Now we have crazy things that people do in Airbnbs, making so much money. There's so many ways to make money in real estate. So I just say avoid that really fight or flight mode where people are getting you to be put in such a fear, like paralyzed state, that you're making decisions that aren't in the best interest for you long term. Like, this is something to write out, and like, Josh pointed out, we're going to have some time to write it out, but just, stay the course, go to the people that actually, the professionals that have been in the business a long time and can give you some history back knowledge, not just trying to make commission or something else.
Yeah, definitely.
Yeah, and I think, I'm sorry, go ahead.
No, go ahead. I was going to say exactly what you said.
Yeah, so, it's interesting because I think if we see softening, which we've seen, like I said, it's shifted more from an extreme seller's market to more of a balanced market. This is a short window that we're going to see. I think there's going to be a lot of pent up demand that comes off the bench in June, July, maybe. And we already had demographics and housing affordability lending itself to being more of a seller's market, being a very solid, strong housing market for a long time. So I think anybody that buys a home should buy a home based on maybe a 3 to 5 year window. I mean, there's cost to buy a home, cost to sell a home. Nobody's buying a home today that's expecting to sell in a month or two, right? So this issue of the market, this actually might be the best time in the next 5 years to buy a home if you look at it like that, because we've got demographics. There's more household formations happening now. That's a stream that's coming probably for a while. Housing is already affordable. Low interest rates tend to drive prices up of homes. And so, if somebody's in the market for a home and it makes sense for their life, now is probably your best opportunity, if you look at it like that, where you have less competition now than you're going to have probably for the foreseeable future. So I think, there's great opportunities all over. And I agree with Deanna and what others have said. I mean, this is not a time it's never wise to make a decision out of fear or when you're upset or frustrated. It's always better just to breathe, take a minute, look at the data, talk to a professional, and make a decision that you're going to feel good about, that you can be happy with for years to come.
Great info. Anything else you want to add, Jen or Zach? Jen?
Nope, I think that's it. Thanks for having me on.
Yeah, definitely. Well, I appreciate all you guys so much. I think this is so informative. Not only does it show such a collaboration from our lending community that you guys can come together and share your different stories. It's not a super competitive market right now. We really want to come from the servant leadership perspective and share abundance and make sure that people are making the right decisions with so much news and information going out there. So I definitely appreciate each one of you so much. And if you want to put in the actual live stream, if you want to put your details in here, so if anybody wants to get in contact with you, if you'll do that for me, that would be great. Okay.
Cool. Thanks for having us, Amanda. Appreciate it.
Thank you.
Thank you for having me.
I appreciate it. Have a good one.
Thanks.
Bye.
Bye.
Nice to meet you.
Bye-bye.